Good afternoon, everyone. This is Stuart Fulton from the Neutral newsletter, and just outside today by my garden. I've got my dog here with me. Lucy, come here. This is Lucy. She's a beagle. She's a great dog. So it's just the two of us out here in the great afternoon and by our garden, just chilling. So, what I wanted to talk to you today about was just more of an extension, low key extension of what Friday's video was about, and that is just decentralizing and unplugging, untying yourself from the central bank and central planners that have been just kind of involved in our economy to too great of an extent for way too long of a period of time. And this really all started more than two generations ago with the Bretton Woods Act in 1944. Then we got off the gold standard in 1971. So this has been going on a very, very long time. We've really started to see the impact of the central planners just controlling our money supply, starting 2008 with that 2008-2009 recession. And since then, like I showed you in graphs, I'm not going to do graphs today, but like I've showed you in graphs, M2 money supply is just steady. It's not parabolic, but steady going up. And it's become parabolic really just in the last 6 months since we with the coronavirus. But the coronavirus was just the pin that pricked the bubble. So what we see now is we're getting closer and closer to this stimulus being announced. I know Trump, even from Walter Reed Medical Center with COVID, he's still tweeting out to Congress and the Senate to get this deal passed. I still think it looks to me like it's going to be in the 1.8 to 2.2 trillion, and we're already at 7 trillion on the 5 trillion in new deficit spending since coronavirus started. So we'll be up to 7 trillion when this passes, whenever that is. If it's next week or week after, we'll see. But the point is, M2 money supply continuing to go up and at a much greater clip here more recently, but yet demand just dropping off. And how do we look at that? Well, first of all, I was informed, and it's public knowledge, that unemployment has been put out there in reports that it's, I think, under 8%, 7.8% unemployment. But yet, if you look at sites like shadowstatistics.com, unemployment is 26.9%. And then CPI, Consumer Price Index, it shows 1.7%, under 2%. Yet if you look on Chapwood Index, which I put in some of my blogs, it's 10% on an average basis. In Texas, it depends on where you are in Texas, but it's a little bit lower, about 9%. And those are 2019 numbers. So the 2020 numbers are going to be higher. So what we have here is inflation is higher than is reported. Unemployment is much higher than is reported. And we have money supply we already kind of discussed, and then demand dropping way off significantly, largely because of this unemployment and just the lack of mobility and lack of traveling because of COVID-19, which again is the pin that pricked the bubble. So as far as the global macro outlook right now in early October, what we're seeing is just a continued uncertainty, and the markets are, I know Bitcoin has been trading sideways, and I'll get to Bitcoin in a minute, but I wanted to talk more global macro. I don't really need graphs as much to discuss that. But and this is my point for why it's important to invest in uncorrelated, decentralized assets. Uh, and what do these decentralized assets look like? Well, Bitcoin is my favorite. Ethereum is I think a pretty good one. It's a minimal percentage of my portfolio, but that's another one. Then gold, I have pretty significant percentage there. Silver, a much smaller percentage. Then that's just me. A lot of people really like silver. It's just harder to get, and I'm more comfortable with gold and gold mining stocks. Another one is fine art, and then in a smaller percentage, I've invested a little bit in digital art, but I probably need to get that percentage up a little bit higher. But fine art investing, I use Masterworks. That's a really good way to even use your IRA through Alto IRA, ALTO, to put your IRA money into fine art, and you can get 14 to even 18% returns on those types of investments. I think with Bitcoin and Ethereum, your returns can be exponentially higher than that. Gold is up and down, but I think 20% returns are quite feasible, if not more than that, next year with gold. Because I think next year we're going to see a faster appreciation of gold and silver and Bitcoin than we have in 2020. And overall, the global macroeconomic backdrop is just the stimulus will clear up. That picture will clear up. It's not clear right now, but it will get cleared up, I think, in the next 10 days. And at that point, money supply is going to grow even further. Unemployment probably won't be affected too much by that, but interest rates are still near zero. They're not going to be going negative that soon. It's going to take more time for that to transpire. But when that does transpire, when we do see negative interest rates, I've said this in several videos and throughout blogs that I've done, that's when I see more devaluation, deleveraging in equity markets. But we'll just have to wait and see when negative interest rates come. It's going to take some time, a lot more time than has just 6-7 months now since COVID-19 started. So it's just a slow process. Now, as far as demand, when this stimulus does take place, if it's anything like the other stimulus packages that we've seen, March, April, and May, maybe into June, we're going to have stock buybacks and therefore asset appreciation with stocks, Bitcoin, Ethereum, probably gold and silver too, will all just come up together. I'm hoping that in the near future we'll see the word I'm looking for is just a break to this correlation between Bitcoin, Ethereum, and the stock markets. But it hasn't happened yet, and I'm going to talk in a few minutes here about what I think it'll take for that break in the correlation to happen. There needs to be a clean break, and it's coming. We just haven't gotten far enough down the road in this process for that to happen. But I want to briefly discuss a little bit more about global macro. We talked about the stock buybacks. Those are loans that would be made to large corporations. They borrow money at these extremely low interest rates, and they have the financial clout to get large loans, to qualify for large loans, to buy back their own stocks and pump their stock price. And it makes money for the board of directors, the CEO, vice president, and the elite leaders of these companies, whether they be in the tech stocks or they could be Dow Jones Industrial, S&P. But the point is, they are the ones who can qualify for these loans. Well, when treasuries and A-rated bonds, B-rated bonds, junk bonds are purchased by the Fed, they go into bank reserves. And these bank reserves are what backstop loans being given by banks. So, when the Fed buys these treasuries, they're not just dumping helicopter money into the economy. It's bank reserves. So you have to qualify for a loan to get access to the money, and that is used by the Fed to buy treasuries. That money is tied up. It's not unlocked to the general public, and that's a big issue when only really larger corporations, large REITs, and real estate backed companies are able to get these loans and then utilize these loans to increase their values. Well, mom and pop corporations, small companies, and I'm a small business owner, so small companies, they don't have access to these large loans. And plus, do you really want to go into, even with low interest rates, do you really want to go into debt and be subject to banks and big bank notes that you have to pay back during this uncertainty of COVID-19? Now, with these, if you're a small company, you can't buy back your own stock and pump your stock price. That is not an option. So that's why we see this wealth disparity in wealth inequality in the U.S. And these stimulus packages and the buyback of treasuries that the Fed is partaking in just exacerbate this problem. And it's not just the U.S., it's all over the world. So there's your wealth inequality, there's your disparity in wealth distribution that's causing a lot of the unrest in the U.S. and other places, but mostly the U.S. And I just really wanted to go through that another time in a little bit more detail. Bitcoin, that's where the bulk of the biggest percentage of my decentralized investing is in Bitcoin. And I mean, really, the Bollinger Bands are getting tighter and tighter. I think the correlation this morning was 0.07. And when that gets down to 0.03, 0.025, really low, it'll take some more time. But when it gets there, man, I mean, Bitcoin is going to be ready for a big breakout. So Ethereum will be drug up with it. There's a correlation between Ethereum and Bitcoin as well. And that's why I have a small allocation into Ethereum. But really, after the election is more likely than before the election, strongly. But in November, next month, man, I mean, Bitcoin really has an opportunity to jump up. It's in the 10.6 range right now. I mean, it has an opportunity to jump up 15, 16, 17,000. We'll see. I don't know. I have my doubts whether it will actually eclipse 20,000 all-time high by the end of the year. But like I said in the last video, who cares? I'm looking at it long term. This bull market could go fourth quarter 2021, but it could just as easily go into the first, second, third quarter 2022. We got a long way to go with Bitcoin, and that's where I put the most money for decentralized investing, uncorrelated investing. And here's something else I want to show you, and another reason why I'm outside today. Well, it's a beautiful day. Fall is the best time of year in Texas. But look at this. Check this out. Can you see that? It's a garden. It's got a ways to go. It's not quite there yet, but how about that? So we're going to grow our own food.